Hi, I'm Chris Stewart with the ARC of Jefferson County in Birmingham, Alabama. I have been with the ARC for 16 years. I'm a CPA and a CGMA. I have operated as the CFO of the ARC for 14 years, and I became CEO 2 years ago. Over that time, we've taken over many agencies in our market due to the financial instability of their agencies. Today, I would like to talk to you about some of those issues and how to avoid them. Excess administrative costs over 8% is a major problem for people that are providing services for people with intellectual disabilities. In our state, we rank 49th in the AAIDD State of the State book. And one way we've been able to compensate for those low rates is our administrative costs. We have administrative costs under 3%. Now, ordinarily, I believe that is a liability, but with our agency, we have a very long-term administrative staff who are able to hold and maintain that level of structure going forward. Now, other agencies that we have acquired over the years, some of them have had administrative costs as high as 22%, and that ends up being a major problem. Look at the things that you can do to actually take those administrative costs down. We've eliminated all of our administrative assistants. We have gone through and worked with different areas and combined jobs. Look at your accounting department. Is there some place in there that they can do other jobs within the agency that actually bring down their administrative costs? Also, we work with HUD significantly in some of our programs, and some of our homes actually provide costs to offset administrative costs in the accounting department. So that is some of the things that you need to be looking at when you're dealing with administrative costs in your agency. Another major problem that we see in nonprofits is that people receive grant revenue. Grant revenue is a great thing, but you must understand that although grant revenue bumps up your bottom line, the grant revenue is there specifically to take care of whatever grant that you got the money for. We see it over and over and over again. People will get money for fixed assets in their grant revenue. The money that amount of money bumps up their bottom line, and they think at the end of the year that they have additional monies to spend. There is no additional money to spend. What happens is that cash comes in, hits your balance sheet, and then the cash comes in and hits your income statement. Although that money is there and it is a credit to your agency that you've been able to get those grant revenues, when you look back on it, those funds are actually temporarily restricted for whatever the grant is for. Now, we don't use fund accounting anymore, but it is important to remember when you're doing this that those revenues are restricted for the grant only, and although they bump up your bottom line, they aren't to be spent. Another thing that we see going forward is that agencies end up with small reserves at the end of the year, and what they want to do is spend those. We've seen that over and over and over again with nonprofits, not only when I was an auditor, but also as now I'm the CEO of the agency. We see these other smaller nonprofits end up at the end of the year with even a $5,000 or a $10,000 reserve. And what they do is they focus on the mission, which is a great thing, and they spend the money towards the mission at the end of the year, not looking towards the future. One thing that you have to remember is when you are building up a reserve, you are making sure that the mission is financially sustainable going forward. Where would the mission be if your agency wasn't around when a rainy day came? Always put money away in a rainy day fund. Intelligent investing is another option for organizations when they have additional monies left over in their budget at the end of the year. You may not think very much of $5,000 or $6,000 being left over in a budget at the end of the year, but if you're able to combine those and keep those going over years and years and years, they can add up to a lot of money. One way that we have done it here at the ARC of Jefferson County is that we have laddered CDs, which means you get, say, a bundle of 6 CDs ranging from maturities of 18 months to 3 months. And as those CDs mature, you roll them out farther and farther along, and you keep receiving interest on those funds. Over time, it builds up significantly and can really help add to the stability of your agency. Realizing the importance of budgeting and financial forecasting is also very important. Many ARCs are not able to have these types of forecastings because they don't have CPAs actually in the organization. But one thing that you can do if you have a very good bookkeeper is putting together a budget and putting together a forecast. That will allow you to see where you are at the very beginning of the year and see where cuts may need to be made. a budget is not 100% accurate. If it was, it wouldn't be called a budget. But it is very important to create one and hold yourself accountable and your different departments accountable for when the overspending occurs, and tell people that they've done a great job when they've gone under budget. As long as the mission can be accomplished and we can stay within budget, everybody prospers. Fraud is a major problem when it comes to nonprofits. Often we get so caught up in the mission and what we're doing that we don't realize that we are being taken advantage of, and therefore the mission is being hurt. One thing that you can do is make sure that your organization has the proper internal controls set up. You can ask your auditor about these, an accountant. Often when you get a financial statement, your auditor will have a report in there about internal controls and where your weaknesses are. Ask your auditor. Oftentimes he will set up an internal control structure for you with the employees that you have that will not only help you minimize the risk of fraud, but also could limit your audit risk and also bring down the cost of your audit in the future. Another thing that we see that leads to financial instabilities in nonprofits is the reliance on fundraising. Fundraising should be a core portion of what you do in your ARC and in any nonprofit agency. But over and over and over again, you will see big swings in nonprofit fundraising. It just happens. The economy changes, or donors get fatigued from giving over and over and over to the same agency. So you have to make sure that when you are building programs and when you are putting programs together, that they are not built on fundraising. They need to be built on solid revenues that you can bring in year over year and can forecast. Cutting costs is another way to make sure that your ARC is financially stable. You can look on the ARC website. They have a price point page where you can order things from Staple at a significant discount. Also, you should be negotiating all of your contracts with any vendor that you have to make sure that you are getting the lowest point possible. Also, make sure that you bid out everything that you do on a large scale. We get 3 bids on absolutely everything at a minimum to make sure that we are getting the lowest price possible. Also, you can look at other things like low-cost health insurance. A lot of employers don't want to go to that, but then you might have individual employees who are young and healthy and that are looking for lower-cost insurance just in case something catastrophic happens. The problem that we see with nonprofits is staying stagnant, focusing on the mission only, and not looking for new sources of revenue. You will see this in lots of smaller agencies that are just struggling to get by. But you have to look for new sources of revenue, whether those are through fundraising, whether those are for starting a business for the consumers that we take care of, or anything to that matter. You have to make sure that you are always looking for new sources of revenue. Another problem that we see in nonprofits is not recording depreciation. A fixed asset that's purchased and is just left on the books. Most nonprofits feel that they don't have to record depreciation because they don't file a tax return. But that's not the only thing depreciation does. Depreciation also sets up a non-cash item to your income statement, which, if done properly and your financial statements are able to handle it, actually builds up cash in your cash account for when the fixed asset is fully depreciated, to where you can purchase that asset again going forward. In conclusion, here at the ARC of Jefferson County, we try to live by these rules. Don't stay stagnant. Look for costs that don't add to the bottom line and don't add to the value of services to our consumers. Make sure that you always are innovating and always taking care of the people that need to be taken care of.